Howdy, howdy, and welcome back to the channel. You got Digital Asset Hutch here, bringing you all the know about the digital asset and U.S. economy space. And today, we're going to go ahead and talk about what exactly went down at that FOMC meeting, and who are they, what did they announce, what were some of the questions they answered, and how did the market react. So if you do learn from anything today, please go ahead and drop a like below and subscribe so you can stay up to date with my most latest videos, because I do have to say I do need to go ahead and brag a little bit, because as you can see here, I kind of called that the 25 basis point hike was coming. We kind of used the CME group tool. We did look into the past meetings and what they were saying and some history through some TA charts. So if you do want to go ahead and see how I did come up to this conclusion, go ahead and go watch that, drop a like and subscribe like I did say, but let's dive into what happened today. So what happened today with the hike was that essentially Jerome Powell came out and said they understand the markets are rallying. They understand the job market. There's a lot of demand for labor. They understand that we are on the brink of actually turning around. But they understand what has happened with his predecessors. They called it too early and they paid the price later. And he understands that. So instead of just ending it right now, what they kind of announced is they plan on slowing it down, keeping it at this 25 basis point hike so they can kind of see how the market is adjusting, because they focused on the housing market. They still said that that is still one of the key places that hasn't officially started to have a disinflation process yet. So they don't want to slow it down until they see that it has officially begun, because as you guys have noticed, the housing market has fallen behind a little bit. Those housing prices are taking a little bit longer to adjust, as those are still really high and the rates are increasing, so you're paying a high price for the house while also paying a high mortgage rate on the house, so you're getting hit from both ways. So he is still a little skeptical on that front, and he is hoping to see that come down. So that is something to pay attention for. But who is the FOMC? As you can see, Jerome Powell is a member of it, and they're pretty much just a group of officials that's responsible for setting that interest rate. So they'll meet around 8 times a year. It could be a little bit longer depending on if we possibly are going into a recession. So are there also, if the inflation's increasing so much, it might meet a little bit longer like they have. So this is who is in charge of like setting the price of money, essentially, is how you could state it, because the interest rate goes on towards loans, and whenever you borrow money, you essentially pay the interest rate for borrowing that. So you could say that's what you do whenever you buy money. So as you can see here, you have to increase interest rates to tamper down inflation, because essentially what happened is during quarantine, we printed off all this money for stimulus checks, increasing the money supply of our economy immensely, and then ultimately now we are starting to feel those problems of it, as you can tell. With some of the prices, some eggs, ultimately, it's become a meme recently of egg prices are through the roof, and that's ultimately one of the reasons why, as long as a chicken factory burning down. But this is all plays into the fact of we're getting these higher interest rates, so essentially they can take that money back out of the economy. So they gave it to us, ultimately now they got to take it back. Look at it like that. So let's go ahead and look at that CME tool again that we did use in that last video, and let's go to the next meeting in March. And pretty much CME Group has already predicted that it's going to be another 25 basis point hike, and that's kind of consistent with what Powell said today. He pretty much, like I stated earlier, they're slowing it down. The question was asked in his Q&A, sorry, about the why not just stop rates for the next 2 meetings and then see the data and then pick up maybe in July again. And like he said, he doesn't want to make the same mistake as his predecessor. He actually did state that he would rather put the rates too high and readjust and put money back into the economy then call it too early, fake everyone out, and then send us into another inflationary period. So they are saying that they're paying close attention to two key areas, which I will also be paying attention to then, and that is employment and housing. So I do suggest we do keep an eye on that in the inflation reports and just the employment data coming out, and I believe that might already be out, so we'll definitely look into that for y'all. And then lastly, we'll go ahead and talk about why it is important to pay attention to these, because as you can see, if the Fed rates are just what the banks lend to each other and these are increasing, ultimately that's going to trickle down to y'all. So how does that affect y'all? Well, your credit card rates will start to increase slowly, as you could possibly see. Loans from your 401k might start to increase if they base it off the prime rate. Some of your mortgages or housing rates, like we said, those are still increasing as these houses are staying the same, so that's a concern for them. Then you have your auto loans, student loans, and just anything that you pretty much hear with a loan at the end of it. Those are all going to increase as the Fed funds increase as well. Because if banks are charging each other more, they're obviously going to trickle it down to their customers, who are you. So let's go ahead, and as you can see here with the markets, they actually did have a nice rally after they did have that conversation. We had a nice break, fake down low of going below 23, and we shot up all the way to a new local high above 24. So sometimes we have seen a bigger pump in the past, but ultimately we are coming out of that bear market, so that is something to keep in mind, and a 5% pump is pretty good, I will have to say. So ultimately, people have been stating that it could be baked in, but I think that this is still bullish news just for the markets because it's ultimately exactly what they are saying they're going to do. They haven't thrown any curveballs at us yet, so they've done nothing to take our trust away from them, essentially. And how has the traditional markets reacted? Which there is something to keep in mind of. So they did increase about 1.5% for tech stocks because the S&P's broken up more of technology, Dow's more of industrial. They both had a nice 1% pump today, but it's got us all the way back up to that last local high. So that is a little concerning that this news didn't actually push us out and up above that local high for the S&P. So definitely pay attention to this the rest of the week. And then I do want to go ahead and shout out Ben Cohen, and I am sorry for that. He can't control that. I can't control those ads, but he had a good kind of following of what Powell said. So if you want to go ahead and look at some of his tweets, he kind of ever since So It Begins, he follows what he said. I did go ahead and like some, so you could go under my Twitter and go to likes and see what exactly was I took away. But that is all I will go ahead and say for today's video. If you did take away anything, go ahead and drop a like below. But I hope y'all did enjoy and stay safe out there. Bye bye.